Hello and welcome to this week's episode of Nucleus Investment Insights. The question for discussion today is, will this be the end of the inventory supercycle? On the agenda, we'll examine the Purchasing Managers Index. Then we'll look at a typical inventory cycle. We'll see where we're at with the current inventory. Next, we'll analyse retail sales and we'll explore the question of whether there's any capacity left for expansion. And of course, as always, we'll cover the investment implications. My name's Sam Kerr, and I'm the Senior Advisor at Nucleus Wealth. As always, we have the Head of Investments, Damien Klassen. Damien, welcome. Thanks for joining us today.
Hi, Sam.
And we also have our Chief Strategist, David Llewellyn-Smith. Dave, welcome. Thanks for joining us.
G'day, Sam. Happy New Year. Good to be back.
It's great to have you back. So just a quick reminder before we get started. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, follow us on your preferred podcast platform. Our show's available on all the majors. For those of you listening in live, feel free to drop your questions in the YouTube live stream chat, and we'll do our best to answer them during the show. So now that we've got that little bit of housekeeping out of the way, we'll get into things. So Damien, I'll hand it over to you to get us started.
Yeah, sure. So we thought it'd be worth having a bit of a closer look again at supply chains this week and just sort of where we are. I think we spoke about sort of mid last year, maybe a little bit earlier, about this idea of this inventory supercycle where you go through what an ordinary sort of inventory ordering cycle is like. Add in some supply chain disruptions, add in the issues with people ordering more goods and services, and you end up with this sort of supply chain, this inventory supercycle that's just way bigger than what we usually see. And I think there's certainly, the longer it goes on, this has obviously lasted longer than we thought. At the time we said, look, 2 to 6 months seemed like a reasonable estimate of how long it was going to last. The Omicron variant and that the problems that sort of caused, we think has been enough to extend it even longer. And there are some transport type issues that haven't got to the bottom of yet. But I guess what we're trying to put forward is that the central tenets of it are still roughly in place, and it's the idea of saying, well, there's one of two. We spoke last week about this idea that when you've got a mismatch between demand and supply, you have elevated inflation, and what the government's sort of looking at doing at the moment is demand is sort of average to sort of a little bit strong, and it's the weak supply that's really driving it. And so if we're going to look at rising interest rates and central banks sort of really trying to tamp down on demand, what we're sort of doing is smashing demand to meet this this lagging supply, and it seems like that might be coming at exactly the right time, exactly the wrong time. So I thought I'd start with the supply chains. It's very hard to measure supply chains. I've got a chart up here from Oxford Economics, which has what they call a supply chain stress tracking, made up of various different things from prices to transport and other factors sort of feed into it. And so we can see that's sort of come off its top. So it's certainly still stressed. The supply chains haven't freed up, but over the last couple of months at least, it seems like it started to ease. And there's I guess there's hope from some quarters that the Chinese New Year slowdown will actually be enough to help sort of free that up a little bit further. Having said that, it could take, we could be a couple of months at least until we sort of see the end of that. I guess I sort of feel like it's going to end quite suddenly, but just not quite sure when. I don't know whether Dave, you got any thoughts on supply chains?
Yeah. I mean, I guess there are two scenarios worth thinking about. One is that it does end suddenly if there's a sort of demand air pocket, perhaps coming out of falling asset prices that we've seen the leading edge of. as markets contemplate tightening or actually get some tightening. And then it could be quite sudden, I think, because the supply side will not have been standing still over the last couple of years during this stress period. They'll be doing all sorts of solutions. And so if we get a demand air pocket, then a lot of those solutions are suddenly going to create or make manifest efficiencies that are being embedded now. And so it could all just unwind really fast. Alternatively, if demand kind of just kind of holds up and slowly peters off as we tighten, then perhaps, it could be a more gradual process. I still think it would be relatively steep, though, as you point out. Once you kind of start to de-stress these things, and they can actually get throughput going pretty well. So it's probably precipitous or sort of moderately quickly.
But the question is, yeah, it's a question.
So
Of,
if it's precipitous,
for a while.
it could be 3 months. The other scenario is probably throughout the second half of the year.
So I guess moving on to like the PMI. So this is what's called a purchasing manager index, and basically what it is it's surveys that have been done for decades from a number of different places, but the ISM's probably one of the biggest ones. And
that's for the US, of course.
The US, yeah. And they basically ask people within companies, are you buying more or less than the prior month? And then why. They sort of dig into the reasons why. And so you can sort of see on this chart that that they've peaked out, and that now they're starting to head down. It still is an expansionary stage, so I think the more normal levels are sort of a little bit above 50. So not quite back to more normal levels yet, but they're certainly turning down in the last month or two. That downturn's well, it's become a lot less strong. So still not, 50 is the sort of the stage beyond, behind which you're contracting. But a normal economy would be somewhere around the sort of low 50s, so 55, 53 to 55, say, sort of a more normal reading from these. So
that's right. So you got headline new orders both coming off, but still pretty strong.
Yep.
And then backlog of orders is starting to come off pretty hard, which is important. Shows that the supply side is getting on top of things, at least the very top end.
And it's this part about the that backlog of orders is that's the part where it's effectively showing this traffic jam where people have ordered and ordered more than once, and so you sort of got orders from one supplier, it's not getting there, let me order another one from a different supplier, and if the first one eventually gets there, I'll sell it later. It's that.
We'll come back to that later when we look at inventories. But yes, and we don't have the PMI inventory chart here to show, but the key one is actually new orders divided by inventories, which gives you an idea of demand versus supply at this point, and it's crashed to 50 now in the US. So that's telling you that the new business that's coming on is now being easily met by capacity on the supply side.
So I'll jump into one of those in a minute. I've got the some of the Chinese one as well. So chart up just sort of showing that the Chinese one it has fallen even further. So they're back down to 50 and close to, it's bounced up a little bit in recent times, but that's sort of back to the stage where it does look like it's into certainly a more normal level. And actually, for China is a a relatively low level for it's basically is at 50s. Basically where it's bottomed out in 2015-16 and bottomed out maybe at 49 in 2019. So it's a low level for the purchasing manager index within China.
Yeah.
We are also starting to see this normalization part where, and I've got another chart up just sort of showing that the goods and services they're very much separated. Where Once the pandemic hit, goods sort of jumped from being sort of 30% of the economy to 36%, so sort of jumped by 5% more of GDP, and it's now starting to drift back down again, back down to 34. And services sort of dropped and is now starting to make its way back up again as well. And that's another. So that sort of, if that keeps continuing in the same direction, then you've got the sort of goods. Three different parts coming to help ease that is more productivity from companies in terms of what they're producing. There's the supply chain. This is the transport side easing as those bottlenecks start to come good, and then the demand as well at the other end. So, and that's where we're talking about it. It could end quite suddenly. It's just a question of when.
Yeah,
So
and
Damien,
obviously the
just
passing of Omicron is going to aid with bringing those two lines back together.
Yeah, Damien, just a question back on the PMI index.
Mm.
Is that a lagging indicator? What is that sort of showing us for the future as well?
Yeah, it's usually pretty coincident, and or leading. So the thing is, their surveys about what is going to happen in the coming months. So it's a pretty good current sort of look at what purchasing managers are thinking. They're not always prescient in terms of it. It can reverse quite quickly in terms, because this is you're asking people on the ground what are they seeing, and so when there's things like, say, the coronavirus coming out or recessions hitting and things like that, often the people on the ground, they're not looking at the big macro factors, and they're not looking at what's happening in other countries. They're just looking at what's happening, and so they can be sort of a little late on that. But having said that, it's far in advance of say, reported earnings profits or well in advance of any sort of GDP numbers and things like that. So yes, so you call it at least coincident and to a certain extent forward looking.
They're pretty good in picking turning points. I mean, they're directional indices. They're not. They don't pinpoint where you are. What they pinpoint is rates of change. So, are things getting better, and by how much? Are things getting worse, and by how much? And where those different descriptions shift from one to another.
Yeah. So I've got some of the ones that help to tell us where this might be going. So that was, David spoke about the new orders versus inventories. We've got that in this next chart where
we do have it
on the one on the right.
Yeah.
Where what this is sort of showing is that the difference between the new orders and inventories, and it's just comparing that to the overall ISM. But what it's done is it's led it by 6 months. So it's basically saying that if you look at where new orders versus inventories are 6 months in the future, that gives you a pretty good idea about where the manufacturing index is going to be in 6 months, in 6 months' time. And so it has turned negative, as you can sort of see from this chart now. And so that's a sign that that unless something changes quite dramatically in terms of stimulus or world economy or pandemic and things like that at the moment it does look like those manufacturing indexes are going to turn down and quite possibly go negative at some stage. And then the one on the left was just sort of comparing global central bank policy versus that same chart. And so, and that's again putting in some leads into the. This is a more complicated diffusion index and advanced sort of 15 months and things like that. But it's the net effect of it is saying what's already happened, what central banks have already done, look like it's going to pull down that manufacturing index to negative levels. And so you've got a few things sort of starting to come together there, sort of all pointing at problems for the manufacturing index coming forward, and that's going to help. Less buying and less business to business transactions is obviously going to help sort of clear up those supply chain problems as well.
Well, it's surplus capacity, isn't it? So
yes. I've just got two other quick charts along a similar type of line. So these again, just sort of these forward indicator type charts, so where people look at other things. So one of these is it looks at regional surprise in purchasing managed index. So basically, how wrong are forecasters getting it? With the finding that basically if forecasters are getting it wrong on the negative side, so it might not actually be negative. They might be saying, "Oh, I think it's going to be quite strong," and it only comes out to be a little bit strong. Then that's a sort of negative surprise, so to speak. So things are not as good as what everyone's expecting, and so this might still be good, but just not as good as expected. And that's what this one on the left is just showing, that that's saying the same thing. So the prices have generally been negative. And that's sort of pointing to further downside. And the last one is earnings revisions as well. And so this is a little bit, you want to be using, this is a very coincident measure. And so it's depending on which way you're trying to get it, whether you're trying to use the manufacturing to help you with some of the forecasts on earnings revisions or vice versa. But yeah, just sort of showing that same factor, that earnings revisions are certainly, the breadth of earnings revisions. So what that means is that sometimes you're getting lots and lots of companies upgrading earnings, and sometimes it's only a few. But the few ones might be really big, and so your overall economy, the overall stock market might be looking good because big companies are upgrading. But when you've got a sort of broad base of companies all sort of downgrading the numbers at the same time, and that's again sort of pointing to further weakness in the PMIs. So it's none of that's baked in, and none of it's for certain, but it certainly looks like the peaks are through in terms of the demand for industrial goods, and that we're starting to come out the other side of it now. So that leads to this idea of what does it mean for the inventory? And so for anyone who sort of I'm just going to run through quickly this idea of an inventory cycle, and how that works. And this is, the inventory cycle is embedded in most economic cycles, like to a smaller extent. Our argument is that this is we've hit a super cycle because of a number of largely pandemic driven factors. But the typical cycle would go with, I've just got here a retailer and a wholesaler and a manufacturer. The retailer is selling $100 worth of goods every period, whether that's days, weeks, months, whatever whatever the order period is for fresh fruit and vegetables. It's probably daily or weekly, and for washing machines and cars and stuff like that, it's probably more like monthly or quarterly. So you got your sales, and then a certain amount of inventory that somebody wants to carry. And so I'll call it 150. And so, if you're selling 100, you want to carry 150 in your inventory, so you've got enough to sell and a little bit spare. And then every month the retailer orders another 100 from the wholesaler, who then orders another 100 from the manufacturer, and that sort of flows down the line. Then what happens is you go into this period where you have a drop in sales. And so let's say it goes from 100 back to 10, back to 90. So you've lost 10. That now means you're sitting with 160 in your inventory. So you've picked up an extra 10, which means you've got too much inventory. And if you're expecting sales aren't going to bounce back, if they're only going to be 90, then not only do you have a spare 10 sitting in your inventory, so I need to order 10 less for this month, and also need to order another 10 less because I'm only expecting 90 going forward. And so so the actual order, the retailer is down 10%. The wholesaler actually ends up being down 35%, and then the manufacturer ends up being down 60% because it's sort of this telescoping. This what do you call it? It's a there's leverage within that. Yeah, it's sort of an exponential effect. The further down you go down the pathway, and so that's why you see that in times of trouble, wholesalers and manufacturers get hit far harder than the retailers. But you also get it going the other direction. And so then I've got on the next table, I've got this period 7, 8, and 9 where it's showing the opposite goes into effect. You bounce back from 90 to 100, and the retailers goes up 11% in terms of its sales, but now the wholesaler's up 39%, and the manufacturer's up almost 70% in terms of its orders. And so And that's because what they need what the manufacturer is effectively doing is saying, your sales have bounced back by another 10, so now you need to order some more, but also you want to fill up your inventory. And the argument right now is that people have also been scared by how much they've been caught short, and so they're going to want to overfill their inventories. So they're saying, maybe they used to have 1.5 times their sales in inventory. Now they might need two times or 3 times. And so that means there's this big sort of pig in the python, so to speak, sort of pushing through this manufacturing where people are trying to order more. Then we've had the problem of transport as well, where transport slowed down. So if you've got your typical cycle used to be sort of 10 days to get from your manufacturer to your warehouses and say out to your retailers, and now that's blown out to 30 days. Well, that means you need to be ordering, you need to be putting in bigger orders to try and account for the fact that you've now got to carry more inventory when part of that inventory is just sitting in warehouses and ships and trucks somewhere between you and your manufacturer. And so there's a pretty reasonable argument that that's where we're sitting at the moment. And if we go back to the normal, it goes back from the 30 days back to 10 days, that frees up all this extra inventory, which you can then sell. And so when you look at the national accounts, that's basically exactly what we've seen come through. So I've got, this is again the US national accounts, but you can see a massive build in inventory. Sorry, massive change in inventories. So lots of money is being spent, and lots of sort of flowing through into that. There still is, inventories still are at relatively low levels, but if you strip out cars, they certainly look less low. So car inventories are very, very low, and we're seeing that come through in high used car prices and hard to get rental cars and things like that. But
if you strip out cars, inventories are overflowing.
Yeah, and then it's a question as to whether people are going to want to fill up the inventories more, though. I guess that's the open question.
So Damien, this is real private inventory. What actually makes up this sort of index here?
Right, this is from the national accounts, and it's so it's basically an account for all companies of what's sitting in there. If you've ordered goods but haven't sold them yet, ordered and received goods but haven't sold them yet, I think is the definition.
Yeah.
I guess. Yeah.
So if you look onto the next chart, you'll see what I mean when I say they're certainly overflowing at the wholesale level, which is kind of the next step down through the supply chain from the manufacturers, where as we pointed out, we're starting to see activity slow. But if you look at the wholesale component on the right-hand chart here, the inventories are absolutely through the roof, and moreover, the next sort of link in the chain is retailers, and their inventories are still low but are now climbing exponentially. So the thesis is basically, as Damo has said, owing to excess demand in goods and then difficulties in getting supply, there's this pig in the python of over ordering that's stuck in the system, and is starting to slowly loosen up. And this is, like what we can kind of see the loosening if we forward to the next chart. Some of the transport bottlenecks are starting to ease in shipping around the world. They're still very high, but they are coming off, and the same can be seen in US rail and stuff. So there are signals that all of these various blockages are starting to ease a little, and there is more evidence of this in transport in the raw materials space, where we're seeing the Baltic Dry absolutely crash. Price for LNG tankers, etc., is crashing as we speak.
Negative at the moment, wasn't it, for LNG?
Well, in the Atlantic, it's gone negative. I think
Yeah.
it's the first time ever.
Yeah.
So, all of the shipping blockages that we've seen that have been driving up prices are all starting to come off really fast as well.
So that's for
Raw
that's for commodities,
materials.
raw materials.
Yeah.
Container stuff is
Goods
still.
is still high, yes, but it is rolling.
Yes.
It looks like it will continue to do so.
Mm.
And so it's just.
And there's a question for some of these is the question is how much of these supply chain problems is because you've had just people off sick from coronavirus or in quarantined and all that type of stuff, and as case numbers seem to be tumbling sort of around around the world, whether that's one more factor that helps to ease this is that if I have 1,000 truck drivers, but only 900 of them can actually drive trucks because 10% of them have been off sick for the last 2 or 3 months, but now it's down to only 5% off sick. That then gets me back up to 950, and then I can start delivering more things.
And we also wonder, don't we, if that isn't also exaggerating employment indexes. So labor supply may also be impacted by this, insofar as if you generally have 1,000 truckies, and 10% of them have been off sick for the last kind of 3 months as we soldier through,
and a different 10%.
There's always a rolling 10%.
Yeah, that's right.
Then you are probably over ordering labor as well. You're employing an extra 10% because you've always got 10% off.
Yes.
So as Omicron passes, there may be some loosening on the supply side of labor markets as well, which would obviously add to the downside of the inflation scare that we've got at the moment. You've got this UPS thing here, just more evidence, Damo?
Yeah. So the other one with the like just sort of showing this is where it's coming through from companies. It's surprising as I dig through and look at the different companies like UPS and some of the transport ones like Knight Swift and all these sort of people who are sort of dealing with it at the coalface, is that their volumes have generally been really poor. So, despite the fact we're talking about this excess goods demand, if you look at the revenues for, say, UPS is up quite dramatically, 12.5%, which for revenue is like an extreme measure, extremely great result. But it's all been in the price. The volumes are actually barely above where they were this time last year, and that's sort of this isn't the exception. There's just company after company showing this same type of factor where some of them are even going backwards in terms of the volumes they're producing, but making it all back and more in terms of being able to put through these prices, which for the companies involved, you just need to the question is, can they hold on to it? But it's more of a factor of just sort of, I guess, clearing up that there are we're not talking about sort of these massive demand levels that will never clear, like the amount of and it's the idea that even with all these lockups, they're still delivering as much as they did last year and even a little bit more, and that it probably won't take much to sort of you don't need to add much more capacity to really start to free it, and but as I said,
or lose just a little demand.
Yes.
I mean, the other component to it is of a sort of political economy dimension is you wonder how much gaming there's going on in it as well. Like, because the inflation panic has become so ubiquitous that it's not, everybody's got a kind of artificial float of pricing power.
Yes.
To work with.
And who gets to hold on to that?
Yeah, who gets to hold on to it? I mean, if we actually return to a relatively competitive space where, these things clear and the narrative of inflation, I guess you'd call it inflation expectations, start to come off, then the whole gaming of price rises, could implode really quickly as well.
Yes, yeah. And well, that's the most important. Like, that's the one. Look, nobody knows, and it's as we're going through every company that's done well out of this, it's a matter of saying, okay, so UPS is a good example. they've picked up a whole bunch on the basis of fuel and demand related surcharges and things like that. Okay, now as demand starts to fall back and there's all this extra supply, the planes start going back between the US and China, and we start seeing the port of LA freeze up and things like that. Can they hold on to these price rises? So they've it used to cost you whatever $20 to send a parcel from here to here, and now it's $22. Can they hold on to that 22, or will competition from other providers sort of drive that back to the $20? Now in this type of market, I sort of feel as if they've got a bit of pricing power, but and there's not many big providers, so maybe they'll be able to hold on to some of it. They'll certainly give back a decent amount. There's other industries where you just look at and you go, there's no way they'll hold on to these price rises. They're commodity type businesses, highly competitive, and they're going to give it back. And there's other businesses that are very loyal customers and high switching costs and things like that, and they probably will be able to hold on to the revenues they put through. So for us, it's company by company is really about trying to dig in and try to work out which of the companies that can hold on to these price rises and which are the ones that have really benefited from them in the short term, but are getting back as soon as things turn.
I will say that in the macro sense, because I mean obviously that's bottom up you're talking there, but in top down terms, the key take out of this is for your asset allocation is that this cycle exaggerated earnings on the way up because you had incredible pricing power, over ordering of everything, big fat margins and huge volumes. But then you're going to do the complete reverse with shrinking margins and falling volumes. And so what exaggerated earnings on the way up is going to exaggerate downside for earnings as this thing unravels.
Yeah, well, and particularly where they've spent capex.
Yes,
that's the part where somebody's gone, okay, whatever it is, it cost me $100 to deliver this from here to here, and so and I've got all these supply chain problems, and so I'm going to spend $500 to put a new system in, so that now it only costs me $80 to send it, and so I've got this, and then when it does clear up, and you're charging 100, then you say, well, I've just spent all this money, I've just spent all this capex to put this new system in. I want to use it. Let me lower my price so I can pick up volume and get a return on my investment. And if everyone's trying to do that, then then prices really get smashed.
Yeah. So, I mean, it doesn't necessarily mean that. Well, I mean, what we're talking about here, this kind of recession, this kind of inventory cycle, it's typical of a recession. Like that's normally when you would see something like this. On this occasion, it doesn't mean necessarily a recession because there's a couple of offsetting factors. One, obviously, as we've already indicated, one of those earlier charts, services are going to climb as goods come off. And so, that's going to give you a substitution of activity rather than disappearance of it. And then there's cars as well, which are a very large component of European and US activity. And, that's a different cycle at the moment that's still got a lot of backlog. And so, so both of those two things will offer, sort of GDP support. But the issue is having had exaggerated earnings across the stock market and now price them into eternity. Is this cycle going to be enough to implode that as earnings compensate to the downside, and we find ourselves with very high multiples and expectations that simply cannot be met?
Yeah, and I guess that's the difference. Like, we're obviously buying stocks,
and as the Fed tightens into it,
Yeah, like we were buying stocks last year on the back of quite high multiples, but we're seeing earnings improving and earnings being upgraded throughout the time. So those multiples even though the stock markets have gone up, those multiples have come down because of that. Because you've seen the improvement in the earnings. And I guess what Dave is positing is saying, well, if you're paying the same amount though, and earnings are starting to fall, then that's when stock markets can reprice quite quickly in
Yeah.
terms of reassessing the outlook. Right. So the last thing we wanted to do, sort of raise, was this idea about this, and I guess that's coming back to this idea of this capacity expansion and operational improvements, and are we going to end up with this excess capacity? And the analogy is the wheels are spinning, but they haven't actually hit the they're still spinning on the dirt or spinning on the mud, and if they can hit the actual road and then take off, that's where you quite possibly all this extra capacity ends up really hitting that demand. So I guess in terms of investment implications coming from this, probably the key one is this idea of trying to find companies that can hold on to margin expansion. Certainly over the next year is about saying who has pricing control and who doesn't, because and that typically means not value stocks. So there's this argument right now about whether you should be trying to buy value stocks, because as interest rates rise, they tend to be the stocks that perform well. The problem with that is that that's usually driven by a strong economy. So we've got this strong economy. Interest rates are starting to rise. Companies are starting to get more pricing power because of there's more demand than what there is supply, and central banks are starting to try and move interest rates down to try and relieve demand. The problem with it at the moment is the demand isn't particularly strong, and potentially weakening for those reasons we spoke about for the flip back between goods and services. And so in the other scenario where it's a growing strong economy, that's where companies that don't have that much pricing power manage to get through price rises and actually manage to sort of grow their business quite strongly, which is why you'd buy value stocks. What we're saying is that why we think this time is different is because it's not a demand driven one, it's a supply problem. And so if the value stocks who don't have that pricing control are the ones you're buying, they're the ones that will quite likely suffer the most if demand turns down, relative to and supply expands. So if you demand, or even if demand doesn't go anywhere and supply expands to meet it.
Yeah, and inflation will come off much more sharply than the consensus is currently expecting.
Yes, exactly. And that sort of leads you to this part is, is it going to be excess capacity? And that's the real danger for if you're looking at a traditional rising interest rate trade, which is go out and buy value stocks. And so yes, that's where we're being quite limited in terms of the value stocks we're including at this point.
So yeah, I mean, there's some other implications in there that stocks are still very highly priced for ongoing boom growth, but it's a head fake if you believe in the inventory cycle. And so stocks themselves, quite aside from what Damo's talking about in finding winners and losers in segments, the overall multiple of stocks is likely to come under pressure. At the moment, we're seeing, a backup in yields that, may have a little further to go, but it can't really get very far. Again, if you think that this inventory cycle is critical, because the Fed's going to tighten it pro-cyclically by accident, by which I mean it's going to tighten directly into what is going to be implicitly a slowing period in the cycle. And so it might get a couple of hikes away and suddenly the economy looks like it's crashing. And, you get a recession panic and stocks all get flogged and, bonds are suddenly bid again. And, at that point, you're looking at, another, a scenario in which another Powell pivot becomes plausible. From
So we
hawkish to dovish.
We've just got a viewer question here from James. So saying, listening to this, it seems like central banks around the world are risking a lot by tightening into this situation. What are your guys' views on that?
I agree, 100%.
Yeah,
I think they're making a mistake. Is what I think.
yeah, and that's where, and I guess this is this is our thesis behind saying, look, it's not the time to chase the market higher and try and just look. This is a bounce. This is my time. Missed my chances to get in before. Let me pile in now because the markets have pulled back a bit. We're saying no. This is a highly dangerous time, and that the odds, in our view, the odds are that that central banks are making a mistake. So it's not a given that it'll absolutely happen that way. There's plenty of other things that could step in and change, but yeah, we'd certainly be very wary of chasing the market at this point.
I'll add. There's one more component to this which we haven't actually listed on here, but there is a second kind of inventory cycle trailing everything that we've described here, and this one's a bit more hysterical, and that is because the inflation narrative has taken hold of markets so strongly, and especially Wall Street cheerleaders and spruikers. They've been pushing the line of that everyone should be buying commodities for inflation hedging purposes, and so that's given the entire kind of inflationary blow off this extra kind of levitation, because you've had very strong bid in oil, but not just oil, bloody everything. It's just any commodity that's kind of got any kind of supply side disruption or any kind of inventory issues at all has just been bid sky high. But I'm positing that a lot of this is fake. It's basically a lot of it's run through futures and through inventory processes that are possible for big players to corner, like warehousing and things.
Well, it's speculation rather than fundamental underlying demand.
Absolutely. And so if this inventory cycle that we're describing today unwinds as the central banks tighten, and it happens quickly, and the entire inflation narrative is punctured, then you have a secondary impact where there'll be a disgorging of all these commodity positions and a second round of selling, of deflationary selling, will take hold. And so you've got a lot of dominoes lined up here if the inventory cycle thesis plays out. A lot of deflationary dominoes.
I think that's probably that probably winds up what I don't know if there's any other questions, Sam, or anything you wanted to.
There's no other questions, viewer questions at the moment, but now's a good opportunity to have our question of the week. So this is for viewers to have some discussion in the comment section over the coming days. So the question for this week is the inventory cycle over? So feel free to post your thoughts and engage with us and some of the other viewers. I hope this gives some of our listeners and viewers some insight about what's likely to play out over the short term. And that almost wraps us up. So, Damien or Dave, have you got any final thoughts you want to share?
No, thank you.
No, yeah, I'm good. Thanks.
Okay, excellent. So we do welcome your feedback on the show, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the YouTube comments below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com and book a call myself or the team. Don't forget to like the video now. And finally, if you know anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. If you'd like to see some more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.